All right, what's up, everyone? This is Kirk here again at Option Alpha. Thank you so much for tuning in back on another episode. This is episode 3, and we've been covering a lot of stuff on expected value, how to calculate expected value, does expected value work? And so what I wanted to do today is to build, hopefully on top of that topic just a little bit, and start to figure out how we can compare different trades to one another. And what we're going to do today is we're going to focus all of our time and attention on using a metric called alpha, which we can use to rank potential trading opportunities. And so, as always, I want to walk through this with you, give you some data, and then we'll jump into the platform and start actually looking at how we can use this, not only just in a manual fashion, but also in an auto trading fashion if you want to do that as well. So we're going to jump right to the slides here so you guys have a good setup for today. As always, by the way, if you are in here and you have a bunch of questions as we're going through these, try to keep them on target to what we're talking about at the moment. So if we're talking about alpha, don't ask a question about zebras or whatever the case is. Like, let's keep it focused to what we're talking about today. But if you do have a question, go ahead and throw your question in the chat as we go forward. I'll take different breaks at different points and kind of pause and make sure everyone's kind of catching up and make sure that we're all paying attention here and answering all the questions as we go. So as always, if you have questions, throw them in the chat. We'll make sure we get to those as we're working through these slides. Okay. So the first thing is, hold on. Sorry, I'm on a meeting. Sorry. Someone's trying to jump in here. So first thing is, over the last few episodes, like I said, we've looked at using expected value as a fundamental concept in determining trades to enter. So if you haven't caught up to episodes 1 and 2, go back and watch those after you watch this one today. But just as a really quick refresher, we're trying to use something different called expected value calculation, which truly looks at not only the maximum profit of a potential trade and the maximum loss of a potential trade, and the probabilities of those happening, but also the partial profit, partial loss zone, which is shown here on the chart. This is that gray area on the slide here, which is the really hard part to calculate. And we just use a lot of computer processing power to do it here at Option Alpha, but we want to make sure we capture that partial profit, partial loss zone, because it truly makes a difference potentially in taking good trades with positive expected value or potentially taking bad trades with positive expected value. So inside of Option Alpha, as a reminder, you can see expected value. We pre-calculate this for lots of trades inside Trade Ideas. And then when you try to make a trade yourself, you try to enter a trade manually, you can also see expected value as you're playing around with the different strikes and the different expirations. So there's no guesswork involved, but if you want to know the math behind it, we don't black box it. We tell you exactly how we calculate everything on the platform, and we tell you how we calculate EV as well. So as a reminder too, by the way, if you do want to get Option Alpha and you're here with Tradier, you can get Option Alpha completely free. As a reminder, by just connecting to your Tradier account, then you get Option Alpha Pro Plus at the highest level, lots of bots, lots of access, completely free, thanks to our partners here at Tradier, which is awesome. Okay, but if we just looked at EV alone, and this is really where I want to start our main discussion here. If we, the last 2 weeks, all we have done is we've looked at what is expected value, does expected value actually turn into realized value of those contracts? We found out that was true last week in last week's research, and have more data that backs that up that continues to be true. So now we have to ask ourselves, like, well, if we just looked at EV alone, basically in a vacuum, we're arguably missing the most important component of a potential trade. And I would argue that we are. And so while EV is great and looking at expected value of a potential trade is great, and it's definitely something nobody does anymore. I highly doubt people are calculating this on the fly because it's hard to do, virtually impossible to do on the fly anyway. So if you are looking at it, great, you've done one good step in the right direction. But if you're just looking at EV in a vacuum, you're missing a huge component. Do you guys know what that huge component of the EV trade is? You can just let me know in the comments, but I'll tell you really quickly here in a second after you think about it. We're missing the most important component, which is risk. So EV in and of itself is really, really good at calculating the expected value of a potential trade that you're looking at. But if you just look at EV and you base all your trades on EV, you miss the potential to calculate and factor in risk. And so basically the goal today is to figure out how do we do that appropriately. Okay. So let's look at 2 potential trades. These are trades that I literally took snapshots of 10, 15 minutes before we got on here. And so I can show you these 2 potential trades side by side. So the left side here, this is SPY. It's an iron condor. The right side is a QQQ iron condor. Build both of these trades inside of Trade Ideas. And you can see that they have the exact same expiration. So there's not much of a difference there. Roughly the same credit, a little bit different credit in these, potential trades that they have, but they're still pretty large credits, right? And what you'll notice is that the days to expiration is about the same because they have the same expiration, right? And if you look at the EV, which is under here, the EV on these trades, and again, we pre-calculate this for you, so there's no guesswork involved. You just put in what type of trade you want. The expected value on the SPY trade, which is on the left-hand side, is $266.26 with a 70% chance of profit, a 70% probability of profit. That's really cool. That tells you if you got into that trade, over and over and over and over and over again, you should expect to make $266.26 on average for all of those trades over time. And your probability of making that is about 70%, which is good. High probability trade, positive expected outcome. Great. That's what we want to see in our potential trades. Now let's look at the other trade here. The other trade on the other side is a QQQ trade. Now this trade, you collect a lot more premium on this trade. You're collecting $821 on this potential trade. This is again just looking at a one lot position, so not multiple contracts. And your expected value on this trade is $282.09. And the probability of profit on this trade is 74%. So if you are just looking at these numbers in a vacuum, which you would undoubtedly know where this and ultimate story is going, and we'll show you as we go forward here, and I'll kind of remove these black boxes so you can see what's behind these. But if you just looked at the expected value, you would say what? You would say that the QQQ trade is potentially a better trade because it has a higher expected value. And on the surface, that's true. The QQQ trade does have a higher expected value. You should make more money, dollars, physical dollars. You should make more physical dollars if you go with the QQQ trade. So the big question you should be asking yourself at this point is, how do we rank different option trades against one another? Because we know that it can't be that easy, that it's just the QQQ trade has a higher expected value, so we just take that trade. It can't be that easy. We have to find some sort of normalizing metric that can normalize different trades across different tickers, different widths, different expiration periods, so that we can normalize them and say, yes, this is how we should rank our potential trades. We need to rank them in a way that normalizes things for the fact that we actually have risk. So what we do here at Option Alpha is we use a metric just called alpha. And that's all we do is we use a metric called alpha, which offers an anticipatory measure of the return on risk. And so it's now building on this concept of EV that we've talked about over the last two episodes, which is at first we have to find the expected value of a potential trade. So after you factor in all of the probabilities, the probability of winning, the probability of losing, and all the potential profits, does the trade itself have a positive expected outcome? You could almost say that that's the first hurdle you have to cross when you're starting to find trades, is you need trades that have a positive expected outcome, that actually have theoretical edge that should play out over time. If you don't even have that, well, you should just scrap the trade to begin with. The next hurdle then is to normalize all these potential universe of trades down to the trades that have the highest potential alpha. And what we do is we take EV, which is the expected value on the trade, and we divide it by the max loss. And what this does is this normalizes things down so that we can look at one metric across multiple types of trades and then try to figure out which one of those trades is actually expected to pay the most amount of money per unit of risk that the potential trade is making. So does that make sense? I know if you have any comments or questions, let me know in the live stream. Make sure we get to those as we keep going, okay? So what we're trying to do is we're trying to normalize things. Like, not all EV dollars are the same. So $10 of expected value might be different than $100 of expected value with different risk parameters. If you have to take 200 times more risk to get $100 versus $10, well, maybe that doesn't make sense for your trading. So what we use is we use alpha to normalize everything down to the ground level so you can look at everything in one single place, okay? So EV provides, as a refresher, EV provides a dollar value measure of the expected return of a trade. But again, like I said, the dollar value lacks context. So even in our example before, $266 versus $280 something dollars, I mean, yes, like one is higher than the other, but it really doesn't add a lot of context to like which trade should I really go for? Like they both are about the same. So is there a way to determine it? And so when we need to compare different risk profiles, we need some sort of other metric to compare this to. So again, we use alpha and we take the expected value divided by the max loss, making it possible to finally compare different trades with different risk profiles on a one-to-one basis. We smash everything down based on the max loss of the position, taking in the full account of risk, and that allows us to appropriately calculate how much expected value or return we should have on these positions. So as a reminder, remember this graph or these two different trades. They were showing these side by side here. So on the left-hand side was SPY, right-hand side was QQQ. The left-hand side we saw here, the expected value was 266. The right-hand side was expected value of 282. So on the surface, if you just look at expected value, you might say to yourself, Kirk, the QQQ trade is the best trade for me. So let's remove these black boxes now. And now what you can see is you can see some of the true metrics that are present. And again, these are not like hidden inside of Option Alpha. We show you these anyway. I'm just hiding some of these to kind of prove a point as we go through the slides here and as we go through the episode. But you can see now that if we take into account the max loss or max potential loss on some of these positions, then what we can see here is that it gets us a wildly different calculation for the anticipatory rate of return on these potential trades. And in this case, the alpha of this QQQ position is only 9.2%. So that's basically taking the 282 divided by the max loss, and that's how we get to the 9.2%. And that's a good metric to use because you can baseline that against other potential trades. And in this case, you can see that this trade over here, this SPY trade, even though it has a lower expected value, it has a better risk profile for this trade because the alpha is higher at 39.7. So this is how we use alpha to then rank and sort trades, because now what we're doing is we're not only taking the calculation of EV, which is great, it's finding us high expected, positive expected value trades, but now we're factoring in the risk side of things. And we're now starting to figure out, okay, which trade actually looks like a better trade. Now, look, if you look at this right now, and if you were to compare these side by side, and even if you didn't have alpha as a normalizing metric, you would clearly look at this and say, well, I could make, $266, but my max loss is $671. And here I can make $282, but my max loss is $3,000. Like one trade, $3,000. For some people, that might be the entire portfolio, and you completely blow yourselves up on one potential trade, just rolling the dice on that trade. That's what we don't want you to do. So you need to look at alpha for your trades in addition to EV, because that's how you can find not only positive expected trades, but also positive expected value trades, but also trades that meet your risk profile that you're comfortable with, right? And it's a way to normalize, well, like this trade looks okay, but what about this trade? And how do I know which trade is potentially better? Now, again, inside of Option Alpha, I don't know if you saw this on the first screenshot, it was hiding right there in plain sight. If you go back and you can watch it, I was just highlighting the EV column, so you probably didn't even pay attention to the alpha column. But inside of Option Alpha, you can rank all of your potential trading opportunities based on all the criteria that you put in based on alpha. And what's so cool about this is that what you can do now is you can say, I want to trade ETFs that are neutral, 15 to 30 days with a high probability of success, rank them by alpha, and you go down the list and pick out the best possible combinations. We'll do all the math and calculations and all the number crunching, because that's what we do best. We do that side of it best. You pick the best trade for yourself, but you can see all the different combinations of DIA iron condors, which right now, or at least at the time I did the screenshot a little bit ago, today, like 12:30 or so Eastern time, so about 2 hours ago, then you can see that DIA actually had some of the best alpha. That doesn't mean it's going to be the case 15 minutes later or 10 minutes later or 2 minutes later. It literally changes all the time. Some come in, some go out of favor, but at least you have a metric that kind of compares everything across lots of different tickers and lots of different strategies, lots of different wing widths, lots of different expirations. Notice here we're comparing 16 days to 30 days to 23 days. I mean, we take all the possible combinations we can think of and try to put them into an area that you can then make these determinations for yourself. So the next big question from here, of course, is, okay, this sounds really cool. I like alpha, makes sense. But if you're a skeptical person like I am, the question you should be asking, and the next big question is, does alpha theory match reality? So this is the same thing that we actually did in episode 2. So if you go back to episode 2, what we did in the last episode in our series here, we looked at expected value, which we taught you about in episode 1. And we said, okay, this expected value thing is potentially really powerful. Does it actually play out? Does theory match reality? So we actually play out trades. Does the expected value actually play out to be the expected value after lots and lots of occurrences? So the same question should be asked here when we use a different metric. Anytime we use a different metric, we should then stress test that metric to see, does the theory of what that metric should be providing actually play out when we see the trade finalized, like kind of like the post-trade analysis. So remember from the last time, and I'll use this one again because people liked it, but if the expectation is you want to get a snowman, but the reality is you don't get a snowman, then we don't want to use that metric. The positions and the metrics that we use have to match not only the expectation and the theory, they have to be intelligently derived in why we use them and what they're meant to do. But then when we actually see the data progress, like after trades actually go through 30 days or 40 days or 50 days and actually go through closing cycles, does the reality match up with that expectation? Okay. So here's what we did. We looked at 960,000 expired positions across 3 strategy types. So short call spreads, short put spreads, and iron condors. Those are the main ones we trade in Trade Ideas anyway. We did 155 underlying symbols. So we did all of the ETFs that we support and then all of the different stock symbols that we support. So we had quite the mix of potential ticker symbols, and this gave us a wide breadth. It wasn't just SPY. Sometimes I hate when you do like see research and it's just SPY. That helps, but that's like a very small sliver of potential trading that you should be doing. So we looked at 155 symbols because we need it to be robust enough to work across everything. It should work when you compare it across a lot of different symbols. And then we also looked at different expirations, everything from 1 day to 72 days. I think the average was about 30 to 45 days. And then, of course, we skipped trades that crossed over earnings or ex-dividend dates. We learned this in the last episode, but anytime you throw in those really volatile asymmetric events like an earnings or crazy ex-dividend dates, which still some wild things can happen and some big jumps can happen, we don't want to trade those. We just want to completely ignore those. We want to do those automatically. We want to trade whatever's left of a normal expiration cycle in the options market anyway. And so here's the results of basically all that testing. Let me show you what this graph shows you. If you're familiar with the last episode, you know what this is. But on the left-hand side here, this is the average rate of return. So this shows you basically that alpha metric, if you will, that rate of return for the potential trading opportunity that you had. And the same thing down here with the alpha buckets that you're kind of thrown into here for these different potential quartiles, I guess you could say, of different positions. Or buckets that we had. And we just kind of bucket them by like 0.05, 0.10, 0.15. There's obviously nuances in here. Some are 0.9, some are 0.6, some are 0.13, whatever the case is. And what we did here is we then graphed the theoretical perfect rate of return. And that is the red dotted line that you see through the middle of this chart. And so if you look at where this like crosshairs basically intersects right here, and you'll see that it's 0 and 0. And what this basically means is that if you found a trade that had a theoretical 0 rate of return, so you didn't make money, you didn't lose money, you just stayed exactly the same, completely 0. If you made that trade over and over and over again using alpha, if alpha said the trade was a 0 expected return trade, then did it actually end up being a 0 expected return trade or not? And you can see that although there's a little bit of deviation, alpha actually is very predictive of the actual returns that you end up seeing at the end of that expiration cycle for whatever that trade is. In the case of this one here, it had 43,000 trades that landed somewhere in the 0.25 or 0.15 to 0.20 bucket. And they were almost perfectly matched up theory to expectation or reality, basically. So if alpha was saying, hey, these trades, if you make these trades over and over and over again across lots of tickers, and you had an alpha that was between 0.15 and 0.20, you actually ended up with an actual return on the risk of those positions of 0.15 to 0.20, which is exactly what it should be, which means it's accurately measuring risk when you start using them at mass scale, lots and lots of trades, lots and lots of opportunities. So this is actually pretty amazing if you think about it. If you don't get crazy goosebumps like watching this, you really should, because this is showing you that you can take a normalizing metric like alpha and the predictive power of alpha is pretty tight for lots and lots of tickers. But of course, we didn't just stop there. We didn't just say, okay, we're going to do just lots of tickers. We actually spread them out into ETFs and stocks too, because I wanted to see what was the relationship of just ETFs, which you don't have to account for any of the like crazy stuff that happens with companies and all that stuff that could potentially happen, mergers, buyouts, news, forecasts, all this stuff right there, right? And so here's what we did. We actually split out this first set and we said, okay, let's just look at the alpha of ETFs only. So these are only ETFs. Again, still skipping over ex-dividend dates, but we don't have to worry about earnings now. And so you got lots and lots of occurrences. And what you find is you actually find that the alpha line, the theoretical alpha line, which is this perfect return on risk line right here in red, actually understated for ETFs the actual return. More often than not, for ETFs, the return was actually better than alpha had predicted. Alpha said, hey, look, the return on these types of trades at a 30 bucket should be 30, right? But then we found that it was actually maybe closer to 35 or 36. So it slightly understated the actual returns of the ETF positions, which was fascinating to see, which means that more often than not, people are expecting these returns and they're paying for those returns as far as risk and premium, and they actually get better performance out of ETFs. Now, of course, your natural inclination should be that if this is the middle line and if ETFs are on the top, then when we start to see the actual return for stocks, you can start to see that alpha basically overstated the potential return for stocks. Now, this means that if we were expecting on an alpha position that was looking at, say, like Tesla or Nvidia or whatever the case is, and if alpha was predicting a return of, say, 0.30, then what we actually saw was maybe a return of, say, 0.10 or 0.15, much wider deviation. Not a lot of occurrences yet. Some of these far out ones just don't have enough data. We plotted some of them, but you can see they still don't have enough data yet. There hasn't been enough trading data for us to actually see this with what we have inside of Option Alpha. We'll just keep getting these better as we go. But it was still generally in that same vicinity of, like, you can see that it's trending in the direction, starting to compress against that expected perfect theoretical ROR line in the middle in red here. Now, what's interesting about this is that you might say to yourself, well, that means I should trade ETFs and I should avoid stocks, right? And I would say at this point, if you're going to do this, you should probably trade both, because the combination of both of these, the wider data set, actually provided the more perfect theoretical expectation matching reality once you actually let the trades go through expiration. So it's not like you should look at this and say, well, I just want to trade ETFs because they were understated and the stock positions were overstated and end up performing a little bit worse. Maybe this is that additional, like, unseen, unexpected volatility that you see generally in stocks. You generally get some of these weird movements where they announce a product or a merger or whatever, have all these things that happen in individual securities that just don't happen in ETFs anyway. So maybe that was some of that pricing in of, like, some of that reality started to happen here in the last couple of months, and that's okay, but it's still trending in the right direction. Overall, though, if you traded a basket of both of these, you start to find that they have, pretty good cumulative performance across the spectrum. Okay. So as always, let me know if you guys have any questions on that. So let me stop sharing this. Let me switch over to my other screen here. And I want to show you some of these inside of here because I think this will help out. Okay, so if you can see this inside of here, what you'll see, there we go, inside of my screen here, is I've actually been doing this. If you remember from the last couple episodes we've been talking about, I've been doing this, and it's on our YouTube channel. You can check it out. It's just an auto trading series that we have, and we're doing a bunch of videos on just like how I'm building this auto trading portfolio and what I'm doing with it and how it's progressing and any changes that I make. And you can see here that what I've basically done is just showed you a pure EV portfolio. It's just a paper trading portfolio. It's experimental, but it's trying to set in motion some of these concepts that we've been trying to learn here, which is that We just want to trade high probability, high expected value, and we want to rank things by alpha, which means we want to take the best trades by the best return per unit of risk that we potentially have in our universe. And here's how it's basically performed with about 1,000 positions. Pretty good win rate, which is what we expected. But if you go down here to the symbols, which is the really important part, you can see it's quite the mix of symbols in here. So it's not like all of our top symbols were just ETFs, right? And this is actually kind of, as it started to play out, we've had quite this accordion motion start to play out where some of our best symbols end up being some of our worst, and then they're back to the best, and then they kind of maybe land in the middle. But you can see our best symbol right now is QQQ, followed by JPM, Microsoft, Netflix, Expedia, Meta, etc., Apple, Starbucks. And then you have some more ETFs, XBI, XRT, FXI, EEM, SPY, EWZ, XLF. So it's not like you can just trade one or the other. I think to get a lot of this, hopefully potentially smooth P&L curve that you're trying to go after, you really have to trade a potentially basket of these securities if you wanted to, or at least be very picky and choosy about which ones that you want to go after so that you ultimately have a good uncorrelated basket or mix of securities inside your portfolio. If we go over to the actual bots that are running right now, you can see I'm running lots of bots on Apple, Costco, EEM, right? I have basically a bot for each ticker symbol, which is how I run it in here. It's eventually how I'll turn it live and do it on the same inside my same portfolio here. But you can see you can run all of these here. And what they're basically doing inside of these bots is they're simply looking for a trade idea. That's it. They do one little quick decision just to space out trades. So you're not stomping on trades back to back to one another, but they basically just space out their trades. And then they look for a potential trade that's, in this case, 7 to 14 days and is looking for a trade. And here's some entry criteria that I put in, is looking for a trade that expires before the next dividend, doesn't have an earnings report or anything like that, and has an EV per contract greater than 0. Now, this I think is one of the most important parts right here is I'm specifically telling my bots in this system to say, look, of all the potential trades that you might find, only take, of course, the first ones that have a positive expected value, right? Because we don't want to take trades that have a negative expected value. Like immediately, if we take trades that have a negative expected value, we're literally shooting ourselves in the foot by doing that, right? So we don't want to do that. Okay, and then the next thing that we want to do is we want to take trades with a probability of profit greater than 70%. Now that to me is just my own personal preference. You don't have to do this if you don't want to, but the whole idea around trades with a greater than 70% probability of profit is that you're taking trades that you should win more consistently than not. You don't want to get into that coin flip mentality where it's like win, lose, win, lose, win, lose. I want to take a lot of winners. It gets me in a good rhythm and makes me like psychologically feel a lot better about the trades anyway. And then I do some filtering for max loss per position. That just keeps my position size down. I don't want to take any trades that have that $3,000 risk. And that's a really good one too to put in there, because if you are just looking at this and you're saying, look, I'm just going to take the best alpha trade out of any of the possible trades that are out there. Well, the problem with doing that is that the best alpha trade might also be the trade with $10,000 of risk, right? So there has to be some give and take here where you have to say, look, I want to do the best alpha trades, but I want to do the best ones within $500 of risk or $300 or whatever is good for you and your trading. So in this case, I do 500. And then the most important part and the easiest way to do this is you rank ideas by alpha. And this, I think, is the most underutilized portion of it. It's just very simple drop down right here at the bottom. Now, you could rank all of your trades by expected value, and some people do this. I personally don't like to do this because it gets us into that mentality that we showed you a couple slides ago, where you could find trades that have really, really good high expected values. They make the most amount of money, but they secretly, like an iceberg in the water, have this massive risk that they're carrying that is subterranean. You don't even see it. You don't even see it below the surface. You're just looking at expected value. So you could do that if you want to. We give you the choice to do that. But then if you use alpha, what you're doing is you're taking that expected value and you're dividing it by the actual max loss on the position, which we're saying here is less than $500 to get the truly best of the best. In my case, the ones I'm looking for, the best of the best for these set of parameters inside of my bots. So it's pretty easy to actually do right here. So what I'm going to do is actually going to go in here to our bots. Actually, I'm going to go to trade ideas and I'm going to show you how to set this up and just auto trade. It's a one-click button. It builds the automation for you. You just fill in all the criteria. But let's say that I want to go in here. Let me just check, make sure no comments. Okay, good. Everyone's doing good. So let's say I want to come in here and I want to get into a new position, find a bunch of trades, and then I want to repeat that cycle. Like I like doing these types of trades over and over and over again. So I want to auto trade this because I don't have time. You don't have time. We don't have time. And we should let bots and automations take care of the heavy lifting for us. So I can come in here and I can say, all right, I want to look at all symbols on my watch list, whatever your watch list is in option alpha. And I want to look at neutral positions. So this would be only iron condors. This is just one example of how you could do it, by the way. You could do it multiple different ways. If you want to build a bot that does bullish positions, build one that does bearish, build one that does neutral, it's up to you. It's however you want to do it. Okay. So I'll look at neutral positions. I'll look at positions that are somewhere between, let's say, 15 and 30 days out. So not quite short duration. I'm not looking at trades that are 2 weeks. I want to get a little bit longer out than 2 weeks, but I don't need to go super far either. I don't need to go 45, 50, 60, 90 days out. So we'll do 15 to 30 days. And I want to look for trades that have a probability of profit 70% or higher. That's just my own personal way that I like to do it. I like the really high probability of success trades. Some other traders here, like my partner and co-founder, Jack, he likes 50% probability, high rate of return. Whatever. It's up to you. It's how you want to do it. So if I like these trades, once I'm done here and I set all my criteria in here, all I'm going to do is click this button up here, just called auto trade. And when I hit the auto trade, I can then choose up to 10 symbols that I want to stuff into a bot. So I want to auto trade this particular set of criteria, and I can rank it however I want to rank it. Let me just cancel this for a second. I can rank it by EV. I can rank it by alpha. I can do whatever I want inside the bot. Remember, we can choose to just rank this however we want inside of our bot as we go. So if I go in here and I want to auto trade this, then all I simply do is hit auto trade. I select up to 10 symbols for each of the bots. So let's just choose a bunch of symbols here. XLU. Okay, good. So I choose 10 symbols. I can say next. I give this bot a name, Kirk's new EV bot. Okay, whatever you want. You can connect it to a brokerage account like Tradier. So if you're at Tradier, you connect it to Tradier. You get Option Alpha for free. Just connect it to Tradier. Start trading there anyway. You give it some capital you want to allocate. Maybe we give it a little bit more money, like 3,000. And then this is where you tell the bot all the position details. So what's cool about this is you're basically just like filling out like an order form, like a menu form to create the bot, and we'll automatically create the bot for you on the back end. You just have to tell us what you want it to do. So you want it to trade iron condors. You want it to trade 15 to 30 days, which is what we said when we filtered this out. We said position sizing, just one contract, pricing 100% of the bid-ask spread. Let's say you want to automatically take exit options at 50% of credit and remove the position 1 hour before expiration. Wait at least 1 day so you're not a pattern day trader. But this, again, presets your exit on every single position. So now I've got my management taken care of. Exit options, watch the position every minute of the trading day. If I got a 50% profit, take it. If I don't, wait till 1 hour before expiration, use 50% or 1 hour. It's just how you can do it. And then I go down here and I fill out all of my criteria. In this case, what I want to do is I want to focus on this criteria down here, which is that no earnings, no ex-dividends. That's what we said before. If you want to skip feds, you can skip FOMC meetings too. So we'll throw that in there. We want to make sure the EV per contract is greater than 0. It has to be positive expected value. In fact, if you want it to be even greater than that, say, hey, look, the expected value per contract has to be above $10. Like I won't have trades that make less than $10 of expected value. Probability of success greater than 70%. I already put that in there. Max loss per trade, we can put in as 500. And then we can do the most important part right down here, which is that we rank these ideas by alpha, which means that once we have this universe that we've collected of all these trades that fit these parameters here, like all of these parameters, there could be 2, there could be 200, there could be 50, like whatever it is at the time the automation runs and I've got a new slot available, then I want to be able to rank them. And I want to rank them by alpha because I'm using the expected value per unit of risk to figure out our alpha. And once I do that, I simply hit create bot. That is literally it. Once you hit create bot, we built the automation for you based on your recipe that you gave us. And then so you go over to your bot settings here, and you can see your beautiful new trade idea scanner is in here, and it's got all of your criteria that you told us to put in here. It's really simple. We kind of basically set up the bones and the structure of it as you go. Once you're good to go, you just simply turn on automations if you want to, and then let the bot start running. It'll start running at the next scheduled cycle. Okay. So does that make sense how we do this? It's really fun, easy way to take what we talked about today, which is a lot of theory and concept around expected value and probabilities, and now using alpha to help normalize things. And it's now putting it into a framework that you can actually physically use in your trading. Again, you can go through here and do this manually just by looking at potential trades. Like I have one called EV Scalp as just like a preset filters, but you can go in here and say, hey, look, I want to find these manually and mess around with them manually. Great. It's up to you how you want to do it. But if you want to auto trade them, you want to get some consistency in there so you know you're taking those good trades, then you can use the auto trade button here to take care of that for you. Okay. All right. So I think that pretty much wraps it up for us. If you do have any other follow-up comments or questions, please do let me know. You can add them in the comment section, shoot us an email, team@OptionAlpha. We'd love to hear what you guys think about this. If you thought this was helpful, please let us know. Give us a thumbs up, give us a like on this video so we know you guys enjoyed this. And until next time, happy trading. We'll talk to you guys soon. Take care.